When should you sell stocks? Never. Well, I will present you 3 cases in which I consider selling. Let's begin with changes in fundamentals, but not just swings around either the cash flow or the income statement, nor the balance sheet. What I'm talking about is a real economy shock that's affecting seriously the company. If the business product or sector is being threatened with demise, maybe the best alternative is to just run away. Few illustrations would be Blockbuster after subscription platforms started to take off, airlines during the COVID-19, or Xerox, a printed corporation in a digitalized age. And don't get me wrong, I'm not implying that there's an objective formula to assess whether an industry is decaying. After all, more than 2/3 of the electricity produced today on Earth is generated via coal or oil and gas, the same resources we used more than 200 years ago. How should you approach this then? Taking a closer look at the entire market revenue to see if the pie is getting smaller, if the share pool of sales is being reduced every year, even the top leaders in the industry will see a decaying revenue unless they diversify to other growing sectors. Check if the company is struggling to find new customers. Either you could go through the 10Ks to see how much as a percentage of their product is being bought or contracted by their top 10 or 20 customers, or see daily active users, compare added clients, year over year, quarter over quarter. The important thing to notice is whether this is only happening to one of them or to the entire market, since that will determine if it is a particular or global problem. Sudden increases in capex due to new technology discoveries that render the current one antique. Often, this is followed by a huge write-down of intangibles. For instance, auto sellers companies regarding the tech as obsolete and taking it out of the balance sheet. Expansion plans could in addition be the cause of capital expenditure increases. The problem would not be that, but rather a flat revenue with the rising costs. Inventory increasing with equity being constant, implying that the business is mobilizing capital, which means that they are not being able to sell their complete float and are accumulating stock massively. That could in the future lead to a liquidity crisis, forcing the company to sell at lower prices. Too much intangible capitalized earlier and each year being depleted, that may signify bad purchases or that they are becoming old really fast. Dividends, instead of buying shares back, that has a lot of reasons, but one of them could be a shrinking market, distrust in the future panorama, decrease in ROIC, decrease in ROA, in general, not for one business, license expiring, could be a pharmaceutical, public utility, or infrastructure business that derive much of their benefits from a government-granted right. Among the other, although remember, AI will do everything. It's not a valid argument under any circumstance to justify that the sector is dying. Only fundamental changes that are either present or contingent, forecastable with a high degree of confidence, can be a precise description to start getting out of an industry. The second time, something better has come in. Recall that every time that you invest, heck, even every action has cost from an economic point of view, not just tangible, though intangible, or also known as opportunity costs. Take into account that it should at least beat the risk-free rate. Otherwise, basically you're not being compensated properly for the risk you are assuming. Today, for instance, this rate is close to a 4%, which means that as a rule of thumb and rough measure, if you start up a business today, the yield or expected return for the next 10 years must be higher than that. But let's say that you've analyzed an enterprise and reached the conclusion that's undervalued and will outperform the risk-free rate. There's still opportunity costs. Investing into other stock that may even yield greater expected returns than the company that you were just about to acquire. If that was the second question, the third inquiry would be, why not just keep buying some of what you already got instead of buying a new one? I know this defies multi-portfolio theory, in which there's no such a thing as being over-diversified, but the trade-off between risk and return is basically flat. From a portfolio of 20 to 30 names, up to a 500 companies portfolio. Even the strongest effect of the diversification's free lunch is seen broadening from 2 firms to 10. Finally, the last time I sell my stocks is when they are above intrinsic value. If you buy a business with a thesis of undervaluation and set a target zone or a specific intrinsic value and the share price surpasses it or go even way beyond, I consider selling. I know what you're thinking. If Harry Markowitz assumes a concave utility function and investors only care about volatility and next period returns, CAPM will underperform under that regime. Well, that may not be what you have in mind. Guess that you're probably wondering about intrinsic value. What is it? There's not only one definition, and some of them even contradict themselves. It could be a discounted cash flow, a multiple, such as EPS times the market average price earnings, EBIT times the sector average EV/EBIT, liquidation value, but what you need to have in mind is an objective selling price for the firm or the equity. It implies appraising how much the business can generate. Think of it this way. To value a local venture, such as a supermarket or a battery store, what you definitely want to know is how much money I need to plug in and when I get it back. For stock it's just the same. The price would be the market cap or enterprise value, in case we are valuing the equity or the whole firm. And the capital would be net income, dividends, EBITDA, free cash flow, whatever. Although, one quick reminder, value investors have lately disagreed with this last one, preferring to hold good businesses for longer periods of time, taking into consideration tax benefits and avoid time in the market. Warren Buffett specifically stated that now his favorite buying span is forever, as long as the business is still in shape and keep getting high returns. There are 3 mainstream valuation methods out there to appraise businesses. I'll try to detail briefly each one of them using the same example. A rental home. The easiest one is liquidation value, which would be estimated how much cash we can generate if we sell the entire assets and pay the outstanding debt. In a home case, that may be summing the value of the furniture inside, the raw materials and labor added, plus an approximation of the land cost. Finally, we subtract any mortgage remaining to arrive at the final value. In the case of a traded company, you go through each line of the balance sheet, calculating an estimated capital recovery. As you notice, this may not be the proper way to do it. The cost of the house has nothing to do with the market price. You could have terribly overpaid for them, render it undervalued, which is not, or paid a low or fair price, which does not represent the home's capacity to generate cash flow because it's at a strategic location. Translated to businesses, some of them could have huge balance sheets with high-cost assets that are now worth a small fraction, or a lot of them really do not use that much capital since they provide services or a strong brand, making them overvalued. Liquidation is mostly used in foreclosures, spin-offs, and shutting down businesses. The second one is relative valuation. The core idea is not to value the asset, but rather price it. If a house in the same neighborhood is valued at $200,000 and has 200 square meters, if mine is 100 square meters, assuming that they are similar, it should be priced at $100,000. Or if the average price for the city I'm living is $2,000 per square foot and I bought a property with 500, the fair price would be $1 million. How do investors apply this method to stocks? Easy. Just take the price and compare it to their earnings. In that case, if the average oil and gas price earnings is 10 and I found a corporation trading at 8 times earnings, I will conclude that the stock is undervalued. Or if I found a company with a free cash flow per share of $5 that grows at 15% and their peers trade at 25 times cash flows, in 5 years, as their FCF per share will be 2, the fair value would be 50. Relative valuation is extremely powerful if it is performed correctly. The general issues that are summoned here are that the company could have lower expected growth or worse margins, justifying that decreasing in price. A stock could be relatively undervalued in an expensive sector or expensive market. For instance, there were some tech stocks in the early 2000s that were trading at just 50 times PE while the market was at 80. Since you are comparing in general, you never really know whether you're under or overpaying. An alternative solution could be to adjust ratios depending on diverse qualities. Under those models, businesses with high growth, better margins, or automated returns on capital would trade at higher multiples than low growth, thin margins, and mediocre returns. But again, we risk investing at a completely over or undervalued market, and we still need a somewhat similar firm or firms. The third one, intrinsic value. Here we can reach a price even if there's no comparable asset out there. For instance, if the cash flow that a rental property generated is $1,200 after tax and our disbursements were $200 from which we bought some stuff to keep the house operational, we can say that our yearly free cash flow, meaning it's available to whatever we please, is $12,000. And here we arrive at a basic equation in which we assume that we'll collect that in perpetuity and have a required rate of 5%. That means that the present value of our home is $12,000 divided by 5%, or $240,000. In this way, we don't really care how much other houses are selling for, and also we not take into account the cost of materials. We're basically valuing a business in relation to how much money it's able to generate. Applied to the stock market, what we want to know is the yearly rent after maintenance and reparation, which is cash from operations minus capex, and its price. So if a firm is able to generate $10 million and our expected return is 10%, we'll value it at $100 million. There's numerous models out there to appraise firms that incorporate different indicators, such as dividends, growth rate, bankruptcy costs, high growth periods, options, and the list is pretty extensive. What you mainly see is cash flows, cost of capital, and the growth rate. The main critique to estimate the value of a venture by discounted future earnings is that they are really dispersed and there's no really exact method to predict these cash flows. Let's do a quick sum up. The three situations in which it is considered worth selling are a real shock hitting the corporation and threatening the industry, something better just appear or keep adding to your current holdings, and terminally, the stock is overvalued. Well, that's it for today. I appreciate you watching the entire video. If you like it, subscribe and hit the like button. If you did not enjoy it, please tell me in the comments why so I could fix it for the upcoming videos. My name is Fausto Catalano and I'll see you soon.